Hello and welcome to the September 2025 monthly market update from Crescent Private Wealth. My name is Omar Basal. Today we're going to be looking at the following topics. We'll review some economic news that occurred in the last month. We'll discuss some of the uncertainty surrounding the tariffs. Next, we'll discuss stocks. We have some good information about artificial intelligence, which is in the news. And then we'll wrap it up finally with some discussion around gold. With respect to economic news, one of the most major items that was released in this past month was the jobs figures for the month of August. So the total number of new jobs created was 22,000, which is low or is one of the lower readings in the last couple of years. The deteriorating jobs picture prompted, or what was one of the reasons the Federal Reserve acted to lower short-term interest rates by 25 basis points. And this was the first cut for 2025, and there may be more cuts in the future depending upon inflation data, meaning if inflation's not running hot, and depending upon the economic news. If it continues to weaken, this would prompt the Fed to do further cuts. Finally, the president is continuing to attempt to influence the Fed. And this could in the future have some effects on the independence of the Fed and their or investors' beliefs that the Fed would act to contain inflation. So in other words, if the president is successful, it could cause the dollar to weaken. It could cause investors' inflation expectations to be higher. So the chart in front of you is just showing you the monthly new jobs created in the US. Going back to 2021. And so you can see that post-COVID, there was some very healthy job growth around 700, 800,000 a month. And then you can see in 2022, that number kind of fell. In 23, it kind of decreased again. 24, again, roughly similar to the 23 levels. And then you can see most recently in 25, it's continued to weaken. In fact, I think the month of June was actually negative. So the negative job growth figures. You may recall that the president, after a very poor report in August, the president decided to fire the head of the Bureau of Labor Statistics, which actually collects and issues these reports. And the new head obviously has only been in for a short amount of time, but even the most recent reading was also very weak for August of 22,000 new jobs. Here are some interesting headlines. As I mentioned to you, Trump fired the head of the labor statistics, and that was a big shock because typically you see that in emerging markets where the president decides to act to remove, or the leader of the country acts to remove the head of a government agency that just releases data. And so what typically happens is investors start to doubt the accuracy of data. For example, in China, much of the data is not, government data is not taken or is taken with a grain of salt, whereas data that is from private sector firms is considered more reliable. So this action definitely was a shock because it's typically something we don't see in Western countries or developed countries for that matter. But again, it did occur in August of this year. And then the second headline is that a court ruled that Lisa Cook, who's one of the governors of the Federal Reserve, can remain as a Fed governor while fighting Trump's attempt to fire her. So the president fired her, and then she went to the legal route to dispute that firing, and it's currently in the courts. So, but again, this is kind of new. In fact, it's never happened before since the Fed's creation in the 1910s. There's never been a president to fire a Fed governor, but in any case, this kind of reinforces the view that the president wants to push rates lower, and there could be some short-term benefits on stocks or crypto or gold from the pushing interest rates much lower, but it could harm the economy if it's not something that is appropriate, because it could trigger inflation. Let's talk about tariffs. So one thing that there was a Liberation Day, which happened in April of this year, where the president released some tariff rates across the world. And at the time, it was seen as a way to equalize what was considered unfair trade, or that basically most countries sold more to the U.S. than the U.S. bought from them. And so tariffs were supposed to equalize this balance, even though, as one person pointed out, I have a eternal trade deficit with my barber, meaning that I buy from my barber every month and the barber never buys from me. So that's normal in trade situations, that one party might buy from the other. Just everyone specializes in what they do best. But in any case, that's a long side discussion. The point is that what we've seen recently is that tariffs are not only being used as an economic policy tool, but they're also being used as a foreign policy weapon. And we'll look at some instances of that. An appeals court in the U.S. came out and said, well, tariffs, we believe, are illegal, the ones that are being used by the president. This was a big shock because not the entire, but a significant part of the economic policy is based on the implementation of these tariffs. So this is going to go to the Supreme Court. And then finally, you can see here the U.S.'s aggressive use of tariffs seems to be encouraging other nations to get together and figure out ways to counter that impact. So here are some interesting headlines. The first one is that Trump sets 50% tariff rate for Brazil. Was it because their trade is so unbalanced? Well, in this case, he's blasting their treatment of a former far-right president. And again, the Brazil is not happy with tariffs. First of all, 50% tariffs is significant. It could significantly reduce certain trade in different industries. It's just too expensive. But it will cause Brazil to think about, do I want to invest in the U.S.? Do I want to do more trade with the U.S.? How it affects other aspects of that relationship. The second headline here on the right is Norwegian funds exiting from the U.S. firms supplying bulldozers to Israel sparks Trump's tariff threat. So Norway has one of the largest investment funds in the world. It's measured in the trillions of dollars, I think $3 or $4 trillion. And they decided, listen, we're very unhappy with Caterpillar's selling of their earth-moving equipment to Israel. We know it's being used to destroy homes in Palestine. Therefore, we are going to exit our holdings of Caterpillar. And when Norway exits a position, it typically affects many other investors that might mirror their kind of ethical screens. And so the U.S.'s response was that, hey, we're going to give you more tariffs. And again, Norway is not going to be happy with getting tariffs, not because of any trade issue, but because of their deciding to exit a U.S. company that is involved in some human rights abuses. The third headline is that the U.S. raises India tariffs to 50% over Russian oil purchases. Again, this does not concern the U.S. directly. It's literally that India is being able to purchase Russian oil for a big discount because of Russia's sanctions, and the U.S. is unhappy about that. And so the U.S. is telling India, well, we're going to increase our tariffs to 50% because you're buying Russian oil. And so again, India, it's a poor country. Therefore, buying oil at a discount is a big deal to them. And the idea that they're simply going to stop buying Russian oil to make the U.S. happy is just non-starter. So again, India is unhappy with that. And then finally here, you can see the U.S. court rules many of Trump's global tariffs are illegal. It was never meant that the president would have the power to do revenue kind of activities. That's always been within Congress. That's why they say Congress controls the purse strings. But the tariffs are kind of being used as a economic policy globally to raise revenues for the government. And I think the court rightly said, hey, that's not legal. And this will go to the Supreme Court to see how they rule. But clearly, if they rule against the tariffs, this is going to upend everything because it will simply, the president's standing among the global nations will be reduced significantly because one of his key economic policies will have been canceled or reversed by the Supreme Court. And then the other thing is that all of the changes that companies have been making in response to tariffs will be reversed. So it's just going to be a mess and probably not be good for U.S. investment in general. This is a nice little picture from an economic conference held in China. And you can see here that the head of India on the left attended Modi. You can see the Russian president is there in the front. The Chinese president obviously is there. Indonesia's president attended. Turkish president attended. Turkey's president attended. Like a lot of big global leaders attended this event. And so it's almost impossible to think that this conference could be held in the U.S., given the belligerence the U.S. has had with so many of its friends and obviously enemies as well. Let's talk about stocks. So the U.S. stocks have rallied partly on expectations of the interest rate cuts that there will be more in the pipeline. So as interest rates go down, stocks become more attractive, and when interest rates go up, stocks become less attractive. The AI boom has caused a lot of investor excitement, and so you're seeing some kind of parabolic moves in a lot of AI-related stocks. And then we have the international stocks that outperformed U.S. stocks driven by a falling dollar. So that dollar weakness continues to be a big tailwind for international stocks. This is the S&P 500 index. You can see here the major decline that we had around Liberation Day, and then the snapback in risk assets. You can see stocks have rallied to all-time new highs. You can also see here the returns of the market. So let me explain this table. The first column is the country. The second column is the return of the market in the local currency. So for example, the US, the local currency is dollar. In Germany, the local currency would be the euro. And then the far right column, it just shows you the return of the market, not in the local currency, but in actually translated into US dollars. So you can see the first row, the US market's up 13%, both in local and US dollar terms, because obviously the US local currency return is the dollar. But you can see here Brazil, their currency is reais, and you can see here that their local return in Brazil is 21% positive, but in dollar terms, it's actually 40%. So that 20% gain between the dollar and the local currency return is from the depreciating dollar. United Kingdom, it's up 12.8% in pounds, but it's up 21% in dollars. Germany's up 18% in euros, but it's actually up 34% in dollars. Spain is up 31% in euros, but it's up 49% in dollars. And then finally, Sweden, it's only up 6% in the Swedish krona, but in dollar terms, you can see it's up 25%. So this is a good way to illustrate how a weaker dollar affects international investor returns. And so we believe that this is actually going to continue because a lot of the economic policies in the US are contributing to a weaker dollar. And a lot of the tariffs and other weapons that have been used against countries, like, for example, freezing of Russian assets in 2022 after it invaded Ukraine, those activities have caused other countries to be concerned about investing in dollars because they understand if there's a dispute between us and the US, all of our US dollar assets could be taken away from us. And so that risk is causing them to invest in gold and to invest in other assets. Artificial intelligence, it's a big topic these days. Market bubbles often are marked by certain mania. So for example, in the late 1990s, there was the internet boom. In the 2004, 5, 6, there was the housing market boom. So typically you're going to have some mania around bubbles. Artificial intelligence is the current mania, and it affects several industries. So it's not like it's just tech. It does obviously affect different groups within tech, like semiconductors, the build out of data centers, but it also affects other industries like energy, because a lot of the high performance computing that's required for these artificial intelligence programs needs a lot of energy, and therefore you need, nuclear power. You need, not typically natural gas, but you need some kind of clean energy that can power this. Companies are spending hundreds of billions of dollars to develop new AI tools. So this AI, mania is real, and we don't know when it will peak, but certainly it's something for us to be very aware of. This chart shows you the how long it took different programs to reach 100 million users. So for example, the far left, Spotify, took them 11 years to reach 100 million users. You can see that in Netflix, it took them about 10 years to reach 100 million users. The next one is Airbnb. It took them about 8 years to reach 100 million users. Twitter took them 5 years. Facebook, 4.5. Dropbox, it took them 4 years to reach 100 million users. WhatsApp, only 3.5. Instagram, 2.5. TikTok, 9 months. And then ChatGPT was actually 2 months. So this is something real. This is not like, a fad. This is very much real. The amount of excitement around AI and what it can and how it's going to upend industries and jobs. This is showing you how much spending is happening from the major tech companies. So actually just 4 of them: Alphabet, which is the parent company of Google; Amazon, Microsoft, and Meta, which is the parent company of Facebook. So you can see here that in 2021, 2022 on a total basis, they were spending maybe 125, $150 billion total together. But after ChatGPT was released, they all realized, wow, we need to up our spending and be on top of this because this is going to change everything. And so now you can see that in 2025, they're going to spend roughly $350 billion. And it's expected that their spending will reach or exceed actually $500 billion in the next few years. So that's a lot of money, and it's going to affect a lot of industries, a lot of companies. This is an interesting chart about ChatGPT. So just to give you an idea of its revenues, its sales. So you can see that in 2023 they had about $1 billion of revenues. In 24, about $4 billion. 25 is expected they'll do $13 billion. And then in 2029, it's expected that they'll have about $125 billion of revenue. So again, just, I don't know, if you're not using ChatGPT or the other AI tools, I really recommend you try it. It's so, it can help with, everything from like cooking to writing a speech to checking something to doing math. I mean, it's really incredible. And it's like having a personal assistant that's PhD educated and can in every field pretty much. So it's not always right, and I'm not recommending you take its guidance and everything, but it is something very, very useful. We're using it, in fact. Gold. So gold prices continue to rally and make all-time new highs. Gold's benefiting from a couple of factors, including the interest rates are going down. As I mentioned, there was a cut in interest rates in September, and there will be further cuts expected. And then the central banks globally continue to buy gold because they just don't want to hold dollar assets. Now, again, people might say, oh, $33,700 an ounce for gold. That seems, and it's an all-time new high. This is way too expensive. And I would disagree with that. So this just shows you where gold prices are over the last year or so. And you can see that they've reached all-time new highs. Now, if you say to me, hey, maybe gold's too expensive, I shouldn't buy it here, or gold miners, the companies that mine gold, there's an upside. I would say to you, well, let's look at whether gold is cheap or expensive. And the thing about gold is because it doesn't have a cash flow, we have to compare it to something else. So in the case of gold, let's compare gold to stocks. Is gold cheap or expensive relative to US stocks? And this chart shows you the ratio of gold to the S&P 500 index. And then this chart goes back 15 years. So what you can notice about this is that, wow, relative to stocks, gold's not expensive at all. Actually, it's one of the cheapest levels it's been at in the last 15 years. So if this ratio were to return to where it was in 2011, that peak there, it would imply gold prices around $10,000 an ounce. And we're sitting today at $3,700. Now, again, I'm not saying that's going to happen tomorrow. I am saying that it's definitely possible to reach that level in the next few years. And therefore, I would say to you, don't think gold prices have peaked and they're going to go down from here. Rather, there's a lot of good reasons to believe that they're going to go higher. So this concludes our presentation. I hope you enjoyed it, and we look forward to our third quarter or the fourth quarter report that we'll release next month.